Suppose you find out about a startup business and are impressed by it in terms of growth, revenue, profits, etc. You also dreamt of having such a business but don't have enough capital to start a business. But how can you own that business without investing much money? The easy answer is to purchase a share of that company. What is this investment called and how does it work? Let's find out in this video. Equity is basically the ownership of a business. A business is divided into pieces called shares, and these shares are subscribed by people in exchange for money or sometimes non-monetary consideration. For example, if I have 1000 shares of ABC company, which means I am the owner of those 1000 shares. And if these shares represent 1% of the company's capital, I am the owner of 1% business of ABC company. For better understanding, we'll see another example. You are 4 people. Each one of you brings 25 crores in order to start a business. Therefore, total capital is 100 crores. At the time of registration, this capital of 100 crores is divided into 10 crore shares of rupees 10 each. Hence, each one of you holds 2.5 crore shares, which represent 25% of the capital or 25% ownership or equity. Let's take this story further. You and your friends now decide to sell 20% shares of your company to the public for raising the money needed for expansion. 20% shares of your company mean 2 crore shares with a face value of rupees 10 each. In case these shares sell for rupees 100 each, which is the market value, your company earns a premium of rupees 90 per share, but the ownership or equity will still be represented in multiples of face value rupees 10. Simply put, if an investor buys 1 crore shares, he is now the owner of 10% of the business. Therefore, an investor purchasing a stake in the company or shares of the company is said to make an equity investment. A company can also issue new shares instead of offloading existing shares. Now, how important are equity investments? If your financial goal is long-term investment, experts may advise you to go for equity. Also, if you want to save taxes and beat inflation, equity is the best avenue. Let's understand this with an example. I have rupees 1 lakh in my hand and 2 options for investments. One is equity and another is a fixed deposit. The rate of interest in a fixed deposit is, say, 6%. And suppose I fall in the tax bracket of 30%. Post-tax return in this case would be 6% multiplied by 1 minus 0.3, which equals to 4.2%. Therefore, after 20 years, I'll have an amount of rupees 2.28 lakhs in my hand. Now, if I had invested the same amount in equity with the assumed rate of return of around 12%, this is generally the return of a stock index like Nifty or Sensex over a longer period. We have seen that Sensex has given a return of 12.58% per annum from 2001 to 2021. If I had to pay a long-term capital gain tax of 10%, my post-tax return would be 12% multiplied by 1 minus 0.1, which equals 10.8%. After 20 years, this 1 lakh would become rupees 7.78 lakhs, which is almost more than 3 times the amount I received in a fixed deposit. Here you can see how your equity investment value is more than triple the return of the FD investment. Are you wondering how your equity investments will pay you? Well, there are 2 ways you can receive returns from equity investments. First, as a shareholder, you may receive a periodic payment made from the company's profits as dividends. Secondly, when the price of a stock appreciates due to the growth posted by the company, resulting in capital appreciation. Now, you must be wondering to put all that you have in equity. Wait before you proceed. There is a thumb rule here that may help you to find the right composition of debt and equity in your portfolio. This rule helps in asset allocation, which differs from person to person depending on their risk appetite, financial goals, income, age, etc. The rule is 100 minus your age should be the weight of equity in your portfolio. So if you are 35 years old, the weight of equity in your portfolio should be 100 minus 35, which is equal to 65%. Hence, if you have rupees 1 lakh for investing, put 65,000 into equity and allocate 35% into debt securities. Do remember that this is a general thumb rule, and basis your risk appetite, you may choose to put a higher or lower allocation into equities. Here again, some of you might be wondering how much returns will you earn from equity investments. Returns from equity are uncertain, though proper research and analysis of various factors involved may help you evaluate the returns you may earn from your equity investments. And what are these factors? These factors include domestic and global factors like rate of inflation, interest rates, political, economic, environmental, and fiscal policy, and more. Therefore, ideally, before investing in company shares, your goal should be to find the right value. You need to do thorough research, review the company's fundamentals, look into its historical performance, and conduct proper analysis before investing. Also, you should look for long-term stability and strengths of the company against its competitors. Now that you know equity yields better returns than other forms of investments and how you should proceed, it is important here to mention that there are risks associated with equity too. Yes, equity investments are not totally risk-free. But in the case of equities with greater risk, there is a possibility of greater profits. And this is the reason for equities being preferred for growing an investor's investment into wealth. When it comes to equities, there are two types of risk associated: market risk and company or sector-specific risk. Simply put, risks that affect the entire market and all the stocks and are uncontrollable are market risks, whereas the risks that are particular to a company or industry and can be controlled through diversification are company or sector-specific risks. For example, when the rate of inflation in a country rises, it affects all the sectors and companies, and you cannot save yourself from this risk. This is an example of market risk, also known as systematic risk. But if a company faces a shortage of funds due to any reason that can be controlled by seeking help from other sources, this financial risk is particular to that company, and hence it is company specific, and you can reduce it by proper diversification of funds. This risk is also known as unsystematic risk. Systematic risk can't be reduced with diversification within equity, but you can always reduce their impact by diversifying your investment into different asset classes like equities, bonds, gold, etc. You can mitigate such risks by allocating assets based on your investment goal, time horizon, and risk tolerance. Let's talk about 3 golden rules that can save your equity portfolio from risks. Invest for long term. Diversify your portfolio and take the advantage of systematic investment plans and systematic equity plans, popularly known as SIP and SEP. SIP and SEP are periodic investments in your favorite funds or stocks to average out the purchase price. Now that you have a clear picture of what to expect from equity investments, let's look at how you can start investing in them. There are 2 ways of doing this. First, through direct investment in shares of companies where you need in-depth knowledge of the company. Investors have complete control of these stocks. Remember, you need a demat and trading account to start with. Secondly, investment through equity-oriented mutual funds where fund managers will do it all for you. They will invest in stocks of multiple companies through a single investment. You just need to open an account with your stockbroker to start investing in mutual funds. Hope this video serves good help to you. In our upcoming video, we will enlighten you on more such concepts. Stay tuned.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.